everybody, Luke Gromen, FFTT. Hope you are well. In the interest of brevity, I am going to jump right in. I want to thank everybody for the question submissions. I think it's going to be a really interesting discussion, so thank you. The first question is from Jamie. Could you break down the mechanics of why a strong dollar pushes the U.S. further into a fiscal dominance position, and conversely, how a weak dollar can help pull the U.S. out of fiscal dominance? It's a great question. It's important to think about what is transpiring in the context of fiscal dominance using double entry bookkeeping, two sides of a balance sheet. So in this case, foreigners globally have borrowed around $13 trillion in US dollar denominated debt per the BIS, and the euro-dollar system overall has what is estimated an effective dollar short position, if you will, of somewhere between 10, 20, 30 trillion dollars. Nobody knows for sure. But it's safe to say you have a very large effective dollar short position out there. So if the dollar goes up, if you're short something and the price of it goes up, you begin to get short squeezed. As a practical matter, this does two things. Number one, it puts pressure on any number of foreign currencies, and it slows global growth as the dollar begins crowding out global growth. As that happens, foreigners need to defend their currencies. That gets to the other side of the balance sheet. Foreigners own $57 trillion gross, $22 trillion net of dollar-denominated assets, including $8 trillion of U.S. Treasury bonds in total. And so they will sell dollar-denominated assets, starting with what they can most easily, Treasuries. And so once the dollar gets too strong, you get into a position where not only will global growth slow, which leads to stronger dollar, which leads to weaker U.S. and global growth, which leads to weaker U.S. tax receipts, which will lead to higher Treasury issuance, which leads to more issuance at a time when foreigners are going to be net selling to defend their currencies. The net effective supply of Treasuries rises. That drives rates up. That drives the dollar up. You go into a debt-death spiral, kind of like what we started to go into last year in the third quarter when we saw the Treasury market crash 20% in one quarter. It begins to feed on itself. Critically, I think the easiest way to think about fiscal dominance is in the context of this true interest expense as a percent of tax receipts that this number we've cited over and over and over, which is gross interest expense of the United States plus entitlement pay-goes of the United States as a percent of tax receipts. Once that ratio gets to 95% on its way to 100%, the dollar starts rising as U.S. deficits crowd out global markets, and that touches off this debt spiral that then feeds back into the U.S. As rates go up and receipts go down, you go over 100%, it puts the U.S. into a fiscal dominance position where the Fed has a choice: stand aside and let Treasury auctions fail, or the U.S. has to slash entitlement spending immediately and permanently to make room for interest. Or the Fed and or Treasury need to inject dollar liquidity, print money, however you want to do it, to effectively finance the U.S. Treasury's U.S. interest expense and entitlements. That, to me, is the most simplistic, realpolitik way to look at fiscal dominance. So once the dollar gets too strong, it touches off this debt spiral. It pushes true interest expense above 100% of receipts because, oh, by the way, as foreigners sell stocks go down. Stocks are critical drivers of U.S. consumer spending and therefore tax receipts, which we saw in 20, 21, 22, 23 on the upside and the downside. And it feeds on itself. So the flip side is also true. You weaken the dollar, you increase room. Foreigners that are short, if the dollar goes down, they have more room. Global growth accelerates. U.S. receipts accelerate. U.S. asset prices accelerate. U.S. issuance falls, foreign selling of treasuries falls, and really the key linchpin in this is the dollar. So if the dollar goes up, it's going to trigger this problem and force, again, this fiscal dominance decision. Do you want to print money, inject more dollar liquidity, or do you want to stand aside as you can no longer pay interest and entitlements out of receipts? in our view, the answer is always going to be inject the dollar liquidity, print more. You can't have Treasury auction fails. It won't be allowed. And politically, I don't think you're going to be slashing entitlements dramatically and permanently anytime soon. So that is how the dollar system feeds back, the dollar's relative level feeds back up and down into the degree of fiscal dominance in the U.S. From Mark, your view seems so logical and looks like the way out. Is there a scenario where the U.S. looks to bankrupt the rest of the world with an ultra-strong dollar? There was a view of that. I think there still is a view of that. I definitely remember being told by people with close ties with Washington that that was the plan in the middle of 2022. They were going to take the dollar as measured by DXY to 110 to 115, they being Yellen and the Treasury, and that, don't worry, this will spur demand out of other assets into U.S. stock market and bonds to drive those prices up. I warned those people close to Washington that that was absolutely 100% not going to be what happened. Rather, the dollar would go up, the Treasury market would dysfunction, and stocks would tank, which is precisely what happened. The dysfunction in the Treasury market eventually got bad enough in 3Q22. Yellen needed to weaken the dollar to avoid precisely what we just discussed in terms of the Treasury dysfunction, debt spiral, fiscal dominance issue. And so when you think about it that way, the try to break the rest of the world with the ultra strong dollar game plan cannot succeed unless the United States government is willing to stand aside and let Treasury auctions fail, and up to the point, and including the point of widespread bank failures in the United States and globally that are not backstopped by the Fed. That ain't going to happen in my view. Up to and including nominal defaults on U.S. Treasuries and or call it 20 to 30% cuts to U.S. entitlements and defense spending immediately and permanently to make room for the higher interest expense that an ultra-strong dollar would mathematically drive. I think those things have zero chance of happening. So I think the ultra-strong dollar, this dollar wrecking ball, was tried. Some people thought it was a good idea right up to the point where it broke the Treasury market in 3Q 2022, 1Q23 with some banking system fallout, and then again in 3Q23. So that would be the cost. The government would have to stand aside, let the Treasury market dysfunction, and have auctions begin to fail with all of the reverberations of that continuing to stand aside. I don't think that's going to happen. From Michael, is there a historical precedent when foreign central banks elected to or were forced to sell treasuries in response to U.S. monetary or fiscal policy? Is it directly relevant to the present situation? So we've seen when it's been forced recently. 2015, you saw China selling, in particular, a lot of treasuries to defend their currency. More recently, or excuse me, a little bit further back, in 1968, you saw foreign creditors of the United States, primarily centered in Europe at that time, begin to say, here's our dollars, we want gold, in response to U.S. guns and butter deficits. And ultimately, there is a view that those actions forced the U.S. to close the gold window, forced the U.S. out of Vietnam, or to begin winding down the escalations, certainly, to basically as a result of the pressures those things were putting, those foreign policy moves were putting on the U.S. fiscal position. I think the first example from 2015 is still very relevant per the prior 2 points. Dollar gets too strong, foreigners own $8 trillion in treasuries. They're going to sell them to defend their currencies. And the problem is that the treasury market, given its size, given relative balance sheet availability in the private sector, the treasury market's gotten pretty illiquid. And so ultimately, at a time when we already have a fiscal problem, when the dollar gets too strong, net effective treasury supplies, which is U.S. issuance plus foreign selling to defend its currency, will get very big, very fast, cause treasury market to get very disorderly very quickly. So it can still happen by virtue of a stronger dollar. I think it is still informative directionally, But we've seen what happens when the stronger dollar forces this Treasury selling really since 2018. Furthermore, we can see echoes of the 1968 moves with what China and Russia and others have been doing, which is sell treasuries, buy gold. But we are not on a gold standard like we were in 1968. So ultimately, the Fed and or U.S. authorities can print dollars to cover over any gaps in the fiscal situation, which is precisely what has been happening. If we go back to 2014, when global central banks stopped growing holdings of treasuries and began buying gold, in theory, that's very similar to what happened in 1968. Back then, we had to get off the gold standard, and we inflated after we went off the gold standard. This time, we can see the Fed's balance sheet, 2014 versus 2024. It went from 4 and change trillion in 2014 to what, 8-9 trillion at peak. So Fed and the U.S. banking system have taken up a lot of the slack in terms of financing U.S. deficits once global central banks stopped doing so on net in the third quarter of 2014. So again, it's not directly relevant to the 1968 situation, but it is, I think, directionally informative, which is to say, when push comes to shove, they're not going to cut the fence, they're not going to cut entitlements. They will, if they have to, grow Fed balance sheet directly by proxy or weaken the dollar. And that's what we've seen consistently happen for the last 10 years. From John, do you see a realistic scenario where a U.S. market crash, financial crisis happens for an extended period of time? Or is it more likely to be like March 2023, where the Fed and Treasury come up with a new program on a Sunday and markets barely sell off? And John shared a really interesting table showing the 1929 crash. It took the S&P 25 years to come back, 70 stagflation, 8 years to come back. Tech bubble in 2007, years to come back nominally. 08 GFC, 6 years to come back nominally. 2022, fastest rate hikes in history, and a banking crisis, 2 years only. In short, no, I don't foresee a realistic scenario unless the United States is willing to stand aside and let Treasury markets dysfunction to the point of sustained Treasury auction failures that drive interest rates up and force the U.S. government to slash defense and entitlement spending to make room for interest payments. I see zero chance of that happening. Now, I think it highlights a really important point, which is a lot of people say, hey, the 29 crash, the Dow fell, 85% from 29 to 33. But the dollar was pegged to gold at $20 an ounce. So the Dow didn't fall against the dollar. The Dow fell against gold 85%. The Dow's down 20% since summer 2019 in gold terms, up in dollar terms. It's down, the Dow is down 60%, 60% since 2000's peak in gold terms. Obviously, it's up massively in dollar terms. The Dow is down 50% since 1966 in gold terms. Obviously, up massively in dollar terms. So now, purists will say, well, that's not a total return index, and there's something to be said for that. With that said, yes, it's not a total return index, but in that case, especially with valuations where they are, wouldn't it make more sense to own gold plus T-bills? Because really the total return difference is the dividend yield, right? So, given these valuations, gold plus T-bills probably, these valuations on stocks, gold plus T-bills probably will do pretty well over the next, call it, decade. So again, I think it's really important to break down, what are we talking about here? What's the currency? What's the underlying currency? In gold terms, yeah, we could have a long duration. We have had a long duration in terms of the time to recover nominally in gold terms. In dollar terms, I don't think that's likely at all, particularly given what we've highlighted repeatedly, which is that the U.S. fiscal situation cannot abide a sustained decline in dollar terms of U.S. stock prices. Full stop. It's too important to marginal consumption, too important to marginal tax receipts, which we saw confirmed in 2023. Stocks went down 2022. Deficit doubled from $1 trillion to $2 trillion. Hume, with U.S. bankruptcies hitting the highest level in 14 years, commercial real estate defaults, rising unemployment, and a global slowdown, when does everyone acknowledge we're in a recession? What forces this realization? Wholesale bank failures? I made a comment, and someone else asked about it on a couple different conversations in the blogosphere recently. I don't think there's going to be a recession. And the reason I don't think there's going to be a nominal recession is that U.S. federal spending is 23% of GDP. In April and May, federal outlays were up 23 and 22% respectively year over year. 22% times 23%, that's 5.1% nominal GDP growth annualized, just driven by the federal government. The other 77% of the U.S. economy that is the private sector, that everybody's watching and that is absolutely slowing, would have to fall by about 6 to 7% just to have flat headline nominal GDP. Now, is the private sector slowing? Sure. Is it slowing 6 to 7% or is it down 6 to 7%? There's no way. There's absolutely no way. And for context, in the great financial crisis, U.S. GDP fell 3% year over year, full year. Just to give you an idea of the kind of private sector crash you would have to offset 20% plus increases in federal spending. Now, will federal spending keep it going at this pace? Well, probably. Entitlements are $3.3 trillion and they're growing 8 to 12% a year. That right there is almost, 1.5% of GDP all by itself. Interest expense. We came into the year at 3.1% interest rates on average. I think we're at 3.4 now maybe. But we're moving to the front end. You're repricing the entire debt stack from front to back. It's entirely possible that 35 trillion of debt, interest at whatever it is now, $1 trillion, probably keeps growing at a 20% clip for the next year. As you reprice all that debt. $1.1 trillion is about 4%. If you grow 20%, there's another percent of GDP growth right there. So I don't think people have been paying nearly enough attention to U.S. government spending's impact on growth vis-a-vis a recession. I certainly wasn't early on. Warren Mosler really turned my head to that reality. We can look through this with a pretty simple thought experiment. $35 trillion in debt, right? Take Fed funds to 10%. That's $3.5 trillion in interest expense, pro forma. If you're doing it, that's 12% of GDP. You'd have 12% GDP growth right there. It would be all interest expense. It would be enormously regressive, but be no recession. You might have a private sector recession, but it's basically COVID all over again. $3.5 trillion in interest stimmies over a shrinking private sector. That's not deflationary. It's very Soviet actually. So I don't think we're going to get a nominal recession, and I think what we're seeing in terms of what markets are doing is beginning to realize that. How would markets react to that? Simple. You can't own long-term bonds in that world. You can't. How can you possibly own long-term bonds in that world? So you're going to start to see the $130 trillion bond market come to the realization, oh my gosh, the rules are different at 120% debt to GDP in the world's reserve currency, with 7% structural deficits at full employment in the world's reserve currency. I can't own long-term sovereign debt. I need to get into assets that better hold purchasing power, stocks, gold, Bitcoin, commodities. And so you're seeing the value of these harder assets relative to long-term bonds. You can call up a chart. Call up S&P over TLT, the long bond ETF. Call up NASDAQ over TLT. Call up gold over TLT. Call up Bitcoin over TLT. It's all the same chart. They're all hockey sticking, which is exactly what you'd expect to see in the environment that I just laid out is happening. From Dan, my question is, will it ever really end? Empires prior followed a pattern of downfall, but don't make me say it, this time is different. With a world so interconnected and dependent on the dollar, slow inflation forever? S&P 50,000 one day? Yeah, S&P 50,000 one day? Sure. But per my prior point, in that world, your tough S&P 50,000, in the world you're describing, that's gold 80,000, right? That's the ratio of gold to S&P in 2009. Bitcoin's probably $1 million in that world, $500,000 or $1 million in that world. That's sort of this financial repression world. Now, slow inflation forever implies that the $130 trillion bond market, full of very smart people, will sit still and year after year watch its purchasing power destroyed. In my opinion, that's not going to happen. We can already see it not happening per the hockey sticking charts of those harder asset classes over TLT I just described. But here's the key. Nobody knows what the trigger is to spook the bond market. It could be a fiscal report. It could be an election outcome. Who knows? You just don't know. The math, everybody knows the math, and everybody's looking around waiting for somebody else to panic first. The one thing I feel very strongly about, though, and this will be very difficult if you're trying to trade a book month to month, because you can't care about this until it's right there. But slow inflation forever implies that a $130 trillion bond market managed by very smart people are going to sit around and let their wealth collapse slowly on a real basis over time. In my view, that's simply not going to happen, and it won't matter until it matters. From Travis, can you do a thought exercise to explore whether the U.S. is intentionally trying to move away from being the reserve currency, and what would be the motivation? There have been some BIS and IMF statements over the years that lead some to believe this. I do not believe the U.S. is trying to end the reserve currency status of the dollar, in my opinion. I do think parts of the U.S. establishment have been trying to change the primary global reserve asset of Treasuries, essentially by discrediting them as a safe haven asset for foreigners. The Russian FX reserve sanctions is a perfect example. The reason parts of the U.S. are doing this is simple. The United States has U.S. dollar Dutch disease. You can find an article about this in the FT in 2019. We are the Saudi Arabia of dollars, which means we have gotten very good at producing dollars, but we're not very good at producing much else anymore. That is all fun and games early on, but then when you have to fight a war in Europe against Russia, who's 1/10 your size of GDP, and all of a sudden you find the Russians are outproducing you. You can't make shells and missiles enough, and suddenly your prize manufacturing asset, arguably, Boeing airplanes, are suddenly having all sorts of manufacturing problems. Why? Because who wants to go into engineering and study all that calculus when you can do business and get a quick MBA, and you can start creating credit default swaps, and it's very profitable. It's much easier to financialize everything. That is the dollar, this dollar Dutch disease. And so ultimately, it has become a matter of U.S. national security to reshore the defense industrial base that has been hollowed out by the terms of having the primary global reserve asset be Treasuries. This is understood at a high level in Washington by some people. And so I think ultimately, no, the dollar is going to remain the reserve currency for a long time to come. The U.S. Treasury bond is already losing its status as primary global reserve asset to gold. You can see that in the data at the central bank level. There's no question. I think that's going to continue. I think it's very good for the price of gold. I think it's very good for the United States. I think it's very good for inflation. I think it's very bad for long bonds on a real basis because, again, the United States cannot afford for rates to just go up and up and up. They will be managed probably by the central bank or its proxies via regulation, etc. That is inflationary over time. From Josh, hi Luke. Can you speak more about the Jacob Fugger investing philosophy you spoke of last year? 25% gold, 25% cash, 25% stocks, 25% real estate. I'm hoping for a bit more spelled out how to build that portfolio. Look, I think you want to own 25% physical gold bullion, different locales. I think cash are essentially U.S. Treasury T-bills, along with cash in the bank. In terms of 25% stocks, I think you want positive free cash flow, good balance sheets, good franchises. That's what I am looking at. I think in terms of the gold allocation, I think it's fair to say, hey, 25% gold, 5% Bitcoin, 20% gold, 5% Bitcoin within that. Absolutely. And in terms of real estate, I think ultimately cash flowing is better. Luxury real estate in areas that have some sort of attractiveness to them, right? Lakefront houses, certain areas, location with real estate, right? So that's how I've always thought about that that Fugger portfolio. From George, if a tier 2 country were to have an FX crisis by year end, which one? I don't know, but what I would do is I would look at the energy importers. I would look at those with twin deficits, and then I would look at those that have a relatively low positive net international investment position or reserve position as a percent of their GDP. And whatever you get by running a search or a sort on that list at the top of that, those would be your candidates that probably run into trouble on the FX side first. From Jason, is real estate in the nations where bonds don't pay more than inflation acting somewhat as a bond proxy? Duration, durable, won't go bankrupt, plus coupon is the rent, plus non-fixed face value. Unlike bonds, it's pretty common in East Asia where people save in overpriced real estate rather than putting money in a bank yielding unattractive returns. In my opinion, yes, that's exactly what's happening, particularly in luxury or sort of finite type real estate that have lower carrying costs. From Wilson, could the U.S. return to a gold standard again? And if yes, what are the short-term and long-term implications of it? What would the gold price have to be in that case? In my opinion, the United States will not go back to a gold standard. I think there's zero chance of that. I do think gold is becoming a neutral reserve asset for settling net energy and commodity related deficits globally, regardless of what the United States thinks or wants to do. Gold, as a result, is up 4x since 2008 in oil terms. It's gone from about 8 barrels an ounce to about 32 barrels an ounce. And I think that number will ultimately move towards 100 barrels an ounce, maybe more over time. 200 barrels an ounce possible, certainly. I think gold could also be used as a sweetener, if you will, for long-term U.S. Treasury bonds. Judy Shelton has talked about this in the past. We talked about it in our last video. Essentially, you would issue longer-term Treasuries at a very attractive interest rates with the inflation risk of those bonds assuaged by a little gold sweetener at a floating price. In other words, you can buy Treasuries at a low rate if you've got a gold kicker that compensates you for the inflation risk, since the bond itself only has inflation risk, no credit risk. So to do that, the price of gold would have to go up a lot. I think the right way to think about that directionally is this point we've made in the past, which is U.S. foreign official gold as a percent of foreign held treasuries outstanding. Long-term average is 40%. 1989, it was 20%. At the highs, when there was an honest-to-goodness dollar crisis in 79-80, it was 135%. Today, it's 7%. So just to get to the lows of the last 50, 60 years of the market value of U.S. official gold as a share, as a percentage of foreign-held treasuries, you would need gold to rise 3x. You'd need it to rise 6x to get back to the long-term average. And if we actually had a dollar crisis like you had in 79 and 80, that would imply 19x. So that's how I've thought about in terms of how gold's re-entering the system and what that could potentially mean for the price. From S, Luke, in your last video, you said to avoid debt like the plague. Assuming you can pay the interest, wouldn't you want to borrow fiat, go long gold with appropriate caveats, i.e. not on margin, but on being able to term out the debt, like taking out a second mortgage or something? No. And I once thought that. And then my friend Dan Oliver had the brilliant chart shared a few years back. I've shared it a number of times with clients, which shows the price of gold in Weimar German Reichsmarks over time. And it basically went from 0 to 1 trillion Reichsmarks over a span of 4 or 5 years, overlaid with the month-over-month price change in German Weimar Reichsmarks as the currency hyperinflated to 0 against gold. And what that chart showed was that if you were levered long gold in one of the great hyperinflations of all time, you lost all your money 4 or 5 different times in 4 years because the volatility was so face-peeling. These are political situations. 4 or 5 different times, people in Weimar Germany, as the currency was going to 0 against gold, dumped gold to buy Reichsmarks because they believed the equivalent of the German government's going to cut spending, or the latest war reparations under the Dawes Plan is going to reduce the burden, or the Reichsbank's going to do QT, or they're going to fight inflation, blah, 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 blah. And blah, 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 here again. The fiscal situation is a fiscal situation. The balance sheet is the balance sheet. You want to know what's going on now? Look at the income statement. You want to know the future? Look at the balance sheet. So, no, I don't want to be levered long. That's why I want to avoid the plague. We are now into one of these political situations. Take a look around. It's getting very political, and unfortunately, I think it's going to get a lot more political. And then finally, from Mel, recent unrest in Kenya sparked by a finance bill that would have raised taxes to pay back IMF loans. Is this a sign of things to come? Is the global sovereign debt bubble finally coming home to roost, with innocent Kenyans dead on the street, some of the first real casualties of too much debt? Who or what is next? Possibly. Sadly, you've got a mix of lots of sovereign debt. You've got scarcer/dearer resources, peak cheap oil. You've got a situation that is historically rare of a rising power versus an incumbent, the Thucydides trap dynamic. You've got very major mistakes made by very powerful people and policymakers in the incumbent places, Anglo-American and Western governments in particular. When you blend all those things up together, you have a very toxic political and geopolitical combination. And so this speaks to the prior point I just made about things are political. They're going to get more political. Ultimately, when you have these situations, when you have that toxic combination, maybe the strongest conviction way to play that is avoid long-term Western sovereign debt. With that toxic combination, the last thing you want to do is loan money to those governments for long periods of time when they need negative real rates just to keep the situation together. So that's my key takeaway. So I'll leave it at that. As always, thank you very much for joining me. It was great catching up. And if you like these updates, check out FFTT-LLC.com for more information about our Tree Rings product, 10 most interesting things. Brief synopsis on what grabbed our attention about them and how we think they could change or are changing a way that we had been looking at the world, or maybe even confirming a way we've been looking at the world. So thanks again, everybody. Have a great rest of your week. We'll talk to you soon. Take care.